I welcome you all on behalf of MI Capital Services on this webinar to discuss about proposed corporate taxes in UAE. As announced on 31st January 2022, the United Arab Emirates will introduce a federal corporate tax on business profits that will be effective from financial years starting on or after 1st June 2023. The UAE corporate tax regime has been designed to incorporate best practices globally and minimize the compliance burden for UAE businesses. On 28th of April 2022, MOF released a public consultation document containing a detailed information on proposed UAE corporate tax regime and seeking views from interested parties on its main features and implementation. The Ministry of Finance welcomes comments on this consultation document by 20th of May 2022, which is tomorrow. This is our attempt to simplify this document for your better understanding. I, along with my bright young colleague, CA Karishma, if you can go to the next slide, which is the cat on the screen. I call Karishma the cat on the screen. We'll share our understanding on the document, and then we shall have a question and answer session at the end of this webinar. During the course of our presentation, please feel free to raise any query you may have in the chat box, and we'll try to address as many queries as we can during or at the end of the presentation. In case we may not be able to cover some of your queries today due to time limitations, we promise to come back to you with our answers on one-to-one basis. Therefore, I request you to leave your name and number as well in the chat box if possible. As we await the detailed legislation on this effect, you may appreciate a lot more information and clarity will follow. This is our first attempt, and we promise to conduct series of webinars as we go along on this subject, dwelling into the details and specifics of certain important topics within this tax regime during the course of following months. Now, I am in UAE for last 18 years, and we all got used to minimum tax or compliance requirements in this country. UAE has long enjoyed tax-free status, which started to change since 2018. When UAE introduced indirect taxes in the name of VAT. Introduction of corporate tax is a big change and reform that will impact how we all conduct business in the country. The introduction of federal corporate tax regime is intended to help UAE achieve its strategic objective and accelerate its development and transformation. The certainty of competitive tax regime that adheres to international standards, together with UAE extensive network of double taxation treaties, will further cement UAE position as a leading jurisdiction for business and investments. This introduction changes UAE status from no tax to a low tax jurisdiction. The chart that you see on the slide shows that there are a handful of jurisdictions having tax rate lower than 15 to 20%, whilst the proposed tax rate in UAE is 9% in comparison. Given the position of UAE as an international business hub and global finance center, the proposed UAE corporate taxation regime will build from best practices globally and incorporate principles that are internationally known and accepted. This ensures that UAE corporate tax regime will be readily understood rather than introducing new concepts that would need to be evaluated by the investors. I would like to highlight the journey of UAE taxation and its international obligations. Before we go into the slides particularly related to the corporate tax provisions. After the announcement of 15 actions that came out of the original base erosion and profit shifting BEPS project in 2015 to address the instances of profit shifting and tax avoidance, the OECD and the G20 inclusive framework have continued their efforts to address the remaining BEPS issues and the tax challenges arising from digitization of the economy. This initiative is commonly referred to as BAPS 2.0. BAPS 2.0 has two parts or pillars, namely Pillar 1 and Pillar 2. Pillar 1 is focused on reallocation of a portion of the consolidated profit of multinational enterprises to jurisdictions where sales arises, as well as the standardization of remuneration of routine marketing and distribution activities. Pillar 2, on the other hand, introduces global minimum tax at the rate of 15%. In October 2021, UAE, along with over about 130 other countries, reached an agreement on BAPS 2.0. The introduction of corporate tax regime in
We are extremely sorry. Actually, our Wi-Fi was not working. So sorry for the interruption.
I'm really sorry for.
Are we?
Yes. Sorry.
Yes.
Yeah. Hi. I'm really sorry for this glitch that we had at our office. Thank you for your patience. I'm not sure where we left, but I think, shall we start again or?
I think we can go with the journey, sir. Probably that is where we left.
Okay.
Yes, sir.
Okay, fair enough.
Yeah.
So I would like to start from the point probably we all lost our connection. I'm sorry for this. But I was highlighting the journey of taxes in UAE. So after announcing the 15 actions that came out of the original base erosion and profit shifting BAPS project in 2015 to address the instances of profit shifting and tax avoidance, the OECD and the G20 inclusive framework have continued their efforts to address the remaining BAPS issues and the tax challenges arising from the digitization of the economy. The initiative is commonly referred to as BAPS 2.0. BAPS 2.0 has two pillars, namely Pillar 1 and Pillar 2. The Pillar 1 is focused on reallocation of a proportion of consolidated profits of a multinational enterprise to jurisdictions where sales arises, as well as the standardization of remuneration of routine marketing and distribution activities. The Pillar 2, on the other hand, introduces global minimum effective tax rate of 15%. In October 2021, UAE, along with over 130 other countries, reached an agreement on BAPS 2.0. The introduction of a corporate tax regime in UAE will provide a basis of UAE to execute its support of the global minimum effective tax rate as proposed under Pillar 2. And more broadly, its commitment to enhancing tax transparency and preventing harmful tax practices. I would now want to highlight, before we delve into the details, Karishma, if you can move to the next slide. Before we get into the details of various different topics covered within the UAE corporate tax regime, I wish to summarize certain salient features of the proposed UAE corporate tax regime. It proposes 0% tax rate of up to net income of AED 375,000 per annum, which is about $100,000. Good news for micro SMEs and SME segment. It also aims to charge 9% tax rate on income over and above 375,000 dirhams. It also talks about some special concessions for free zone entities, subject to satisfaction of certain conditions, which we will cover in detail during our presentation today. Again, it is a corporate tax. It does not propose to tax individuals on their personal income, like salaries. Further, it specifically exempts investment income, i.e. rental income, dividend income, and income from debt and equity securities, even for corporates. In addition, it does not aim to charge taxes on capital gains arising from transfer of or sale of capital assets, even for corporates. Again, withholding tax for any foreign payments are capped at a blanket rate of 0% in this proposed tax document, consultation document. The proposed tax regime mainly targets income derived from UAE trade and business. And finally, there are provisions of creating tax groups, carry forward of losses based on internationally accepted tax principles. So these were the main salient features if I had to summarize everything into one slide. Now I wish to invite my colleague Karishma to walk us through various topics within the proposed UAE corporate tax legislation. Karishma, over to you.
Thank you, sir, and good evening all. Well, to begin with, there are n number of topics which has been covered in the public consultation document, but I would really like to highlight only those points which are important from the business point of view. Today, I will be covering taxable persons, exempt persons, free zones, basis of taxation, calculation of taxable income, interest capping rules, non-deductible expenses, tax losses, groups, corporate tax liability, withholding tax, filing due dates, and finally, the conclusion. Now let's get started with the actual proposed law. Now the first and foremost question which any person has by reading any law is that whether I am a taxable person or not. So let me thus explain you what is meant by a taxable person under this proposed law. Now as per the proposed law, any person being a sole proprietary, LLP, firm, joint stock company, private company, ventures, and others having a separate legal identity will be considered as a taxable person. Whether or not they are incorporated, it will be considered as a taxable person. Even the legal persons who are incorporated in foreign jurisdiction, but they are effectively controlled and managed from the UAE will also be considered as a taxable person. Well, the notable point in this section is that individuals earning salary are kept out of the purview of this law. So individuals who are conducting only business will be considered as a taxable person. Unlike any other law, any other existing laws, there are certain class of persons which are kept exempt which are being kept exempt. Similarly, even UAE corporate taxation has kept some of the persons exempt from those categories, and those include government and government departments, along with the government-owned companies. Certain pension funds have also been kept out of the scope. Apart from that, business engaged in extraction and exploitation of UAE natural resources will not be liable to corporate tax as they are already liable to pay emirate level taxation. Charities and public benefit organizations are also out of the picture. The most notable category of person is the investment fund, which has been kept out of the purview of corporate taxation. That is, they are the exempt category. I would really like to highlight this exempt category of person in detail. Now, the UAE offers comprehensive investment fund regimes and fund vehicles that cater a wide variety of fund manager and investor requirements. With introduction of corporate tax, it gives an opportunity to further increase confidence from international investors and bolster UAE position as a location for the choice of investment funds, investment fund managers, and entities used by investment funds to hold their assets or invest their funds. Now, for the investment funds to claim exemption, there are certain conditions which they are required to satisfy to claim the exemption. And these are, the first and foremost requirement is the investment fund is regulated by a regulatory authority in the UAE that is recognized by Ministry of Finance, that is DIFC, ADGM, SCA. Another important requirement is not more than 50% of the economic interest is held by a group of 5 or less than 5 investors, or even the related parties. A single investor does not hold more than 20% of the greater economic interest. And lastly, interest in investment funds can be traded on a stock exchange in the UAE or are widely marketed and made available to the intended category of investors. Probably the topic of interest for all, free zones. As we all know that free zones in GCC are the most benefited zones from all aspects in comparison to other zones that have been central to achieving the country's aim of encouraging foreign direct investment and enhancing the ease of doing business. Similarly, they get a special exemption and position in the corporate tax regime also. So now there are around 50 free zones situated in the UAE, and every free zone has its own norms and regulations. It will take me a complete another session to explain each and every free zone category and how they will be benefited from the corporate tax. I would really not like to deviate from today's session, but soon we will have a complete entire session on free zone where I'll be explaining completely about the free zone. Till now, till then, I would just like to give a brief introduction to in general for all the free zones. So if you're an entity registered in the free zone, you can benefit from 0% corporate tax on income earned from transaction with businesses located outside the UAE, as well as you can benefit from 0% corporate tax income earned with businesses that are within the free zone, maybe the same free zone or other free zones. However, a free zone that has a branch in a mainland UAE will be taxed at the regular corporate tax on its mainland income and benefit from 0% corporate tax on its other income. Similarly, where a free zone person transacts with the mainland UAE but does not have a mainland branch, that is apart from the related person, the free zone can continue to benefit from 0% tax rate if its income from mainland UAE is the passive income. Other income will be chargeable to normal corporate rate tax. Now, what does mean by passive income is interest and royalties, dividends and capital gains from owning shares in the mainland UAE companies. Now, as UAE wants to maintain its status as a leading regional hub, therefore 0% corporate tax regime will apply to transactions between free zone persons and their groups located in mainland UAE. However, payment made to free zone persons on mainland group company will not be a deductible expense, which is discussed further in the presentation. Now, apart from above exemption, a free zone person located in a designated zone for value-added tax purposes can benefit from 0% corporate rate tax on income from sale of goods to UAE mainland businesses that are the importer of record of those goods. Any other income of the free zone from mainland income will be taxable under the corporate tax regime.
Karishma.
Yes, sir.
Karishma, I want you to take a pause here because we have a question from a dear friend and a senior colleague, Mr. Shailesh Ji Sinoy, and he is asking a same question, and I'll read out his question to you as well, if you don't mind. Sorry for interrupting.
Sure. No, sure, sir.
Sub clause 3.29 under main clause 3.8, he's saying, I may sound odd, but reading it carefully, I found an interpretation issue with regards to this clause. Does this clause mean having a branch or mainland disqualifies a free zone company from 0% tax benefit it would have otherwise enjoyed on sales to mainland customers who are importer on records, or does this clause mean that only the branch will be taxed at the regular rate of 9% on its mainland source income, and the company would continue to enjoy the 0% tax status on sales to mainland who are important records? From Shailesh Sinoy. So I have my views on it, but would you like to make any point on this?
It's a reading. This is what it is. It can be interpreted that exactly the branch will be taxed at the regular rate of 9% on its mainland source income, and it will have 0% tax status. That it will enjoy the benefit of 0% on on sales to mainland customers other than those.
So, so it is very clear in this particular document that designated free zone have a distinctive advantage even compared to non-designated free zone entities when it comes to sales to mainland entities. And designated free zone will continue to enjoy 0% tax rate. When you have either a non-designated free zone entity or a branch entity, you will be taxed at a rate of 9% from a UAE sourced income. So I think from the basis of the document, it is very clear that designated free zone do have that distinctive advantage. So moving on, Karishma.
Yes, sir. Now, another important aspect to consider under the regime is the residential status of the person. The document clearly specifies a resident and a non-resident, as residency is the key determinant of whether business profits will be subject to corporate tax in the UAE. Now, a resident will be taxable on the worldwide income in the UAE. I repeat again, worldwide income will be taxable. The following are considered as resident as for corporate tax regime. A legal person that is incorporated in the UAE, legal person as discussed earlier, any natural person who is engaged in the business or commercial activity in the UAE, and a foreign company, if it is effectively managed and controlled in the UAE, it will also be considered as resident for the purpose. On the other hand comes the non-resident. Now, non-resident will be subject to corporate tax only on the income from the permanent establishment in the UAE and income which is sourced in UAE. Now, what is meant by permanent establishment? Let me highlight it. The concept of PE as an important principle of international tax law used in the corporate tax regimes across the world. The PE concept used, the proposed UAE corporate tax regime, has been designed on the basis of the OECD Model Tax Convention. The trigger for permanent establishment for a foreign company in UAE will be determined by the following two main tests. First will be the fixed place of business test, and the other will be the dependent agent test. We can have a separate session on the basis of taxation and permanent establishment in upcoming days. If you all want, kindly share that kindly let us know in the chat box. Now, it has been mentioned in the document that UAE sourced income will be taxed. But what is meant by UAE sourced income? I would like to highlight those points. Firstly, if you are earning from a UAE resident person, it will be considered as a UAE sourced income. Secondly, if the payment is attributed to a permanent establishment of a foreign company in the UAE, then also it is considered as a UAE sourced income. And if the income is derived from activities or contracts performed in the UAE or assets located in the UAE or rights used for economic purposes in the UAE, it will be considered as UAE sourced income. Same principles of UAE sourced income will be applicable to free zone persons which earns from mainland UAE. Moving forward to the calculation of taxable income. Now, corporate tax shall be levied on the accounting net profit or loss in the financial statements prepared as per international financial reporting standards. However, if any alternate financial reporting standards are used for preparing the financial statements, then income can be calculated as per those methods, and that income will be considered as your taxable income. Now, irrespective of the method of accounting used, it has been clearly specified in the proposed law that any unrealized gains or losses on the capital assets or on capital items will not be allowed to be deducted from your taxable income. Apart from that, any revenue item, any gains or unrealized gains or losses on your revenue item, it will be allowed to be deducted from your taxable income. As discussed in the basis of taxation slide, I have mentioned that the UAE resident companies will be subject to UAE corporate tax on their worldwide income, including the capital gain. However, to avoid a double taxation on the income, certain exemptions have been granted to them. The proposed consultation document clearly specifies that a corporate shareholder, that is the company registered in UAE, will be exempt from dividends and capital gains earned from shares held of a foreign subsidiary company, subject to certain conditions are met. And one of the primary conditions is that it must hold at least 5% of the shares of the subsidiary company, and the foreign subsidiary company pays at least 9% of the income tax on the income earned. Along with that, dividend and capital gains earned from any UAE company, which may not be related, will also be exempt. Also, dividend and capital gains earned paid by a foreign company in both UAE and foreign companies will be exempt from corporate tax, provided certain conditions are met. Now, lastly, a non-resident earning income from operating or leasing aircrafts or ships used in the international transportation will not be subject to corporate tax in UAE. Again, it also comes with few of the conditions. Now, after income to be considered, let's talk about the allowability and disallowability of expenses. Under other corporate income tax regimes, expenses are generally deductible where they have been incurred to generate taxable income. Businesses are also expected to maintain the relevant supporting documents to substantiate their expenses. There are n number of deductible and non-deductible expenses, and there has always been a debate under all the tax regimes that what will be considered as a deductible expense and what will be considered as non-deductible expense. Generally, deductible expenses would include the interest expenses, the payment to foreign related parties, depreciation calculated as per the law, salaries, wages, overheads, and so on. And non-deductible expenses generally include excessive depreciation, expenses incurred to derive exempt income, expenses in private income, and fines and penalties. As of now, no such clarity has been given in the proposed law that what will be the deductible or non-deductible expenses. We expect further details on these, and as soon as they are being provided, we will help you with those. Till then, I would like to bring your attention to the expenses which have been specifically explained in the document, and one of the most important expenses is the interest expense. Now let's study in detail about this interest and financing cost. To prevent different tax treatment of equity and the debt, the proposed UAE corporate tax regime will cap the interest expense only up to 30% of the EBITDA. However, to reduce the administration burdens, businesses may be allowed to deduct the certain amount of expenditure irrespective of the EBITDA rule. Now, considering the different industry requirements, this interest capping rule will not apply to banking, to the banks, insurance companies, and certain other regulated financial service entities, and it also will be not applicable to natural persons. Now, with respect to related party borrowings, interest on related party borrowings, there have been specified certain conditions to satisfy and to claim 100% of the interest expense on them. The three conditions are: the first and foremost condition specifies that it should be at arm's length price. Secondly, it should have a valid commercial reason for having the related party borrowings. On top of that, the valid commercial reason will be considered to be exist if the related party lender is subject to corporate tax or an equivalent tax of at least 9% on the interest income which is earned by that related party. Now, there are certain non-deductible expenses as well, which have been specified in the proposed law, and these expenses will not be allowed to be deducted while calculating your taxable income. These include related party payments to free zone persons, 50% of the expenditure incurred to entertain customers, shareholders, suppliers, or other business partners, as they have some non-business or personal element as well. That is, only 50% of those expenses will be allowed as deduction. Further, the administrative penalties, recoverable VAT, and donations to non-approved organization will not be allowed as deduction. Now, it is very common practice to have informal meetings and claim this expense as deduction from the income earned from business. I think Ministry of Finance have taken note of it and seems that restricted these guest entertainment expenses only up to 50% of the expenses incurred. Unfortunately, your wining and dining expenses are only partially exempted.
Karishma,
it's just an illustration.
I would like you to take a pause on this slide. Slide.
Yes, sir.
We have again a valid query raised by Mr. Shailesh Ji Shinoy, and he is asking this, that 50% of entertainment expenses is disallowed. However, there is no clarity on how the entertainment expenses would be defined. This is true, by the way. Sometimes the entertainment expenses incurred is a result of contractual obligation. For example, contractually, if a product is a subject to inspection before sale, then the customer needs to send his representative for inspection. Expenses are incurred for their stay, travel, food, and a part of it will come under entertainment expenses as well. Will 50% of these expenses be disallowed? I would like to take this question, Shailesh ji. I think, the document clearly specifies 4 categories of entertainment expenses incurred for 4 of these categories, which are customers, shareholders, suppliers, and other business partners. So unfortunately, what it looks like, the authorities seems to have covered wide range of people or shareholders or suppliers that we may deal with, and anything to do with the entertainment of them, 50% of that seems to be, as per the proposed document, will be disallowed. And you are right, the definition of entertainment expenses is not there, it is not clear yet, but we would expect travel, food. I'm not sure about stay though, but at least probably the travel and the food might get specifically covered into that as we go along. But we will still await the detailed definition on that front. Hope this clarifies. Moving on, Karishma.
Yes, sir. I would like to now bring your attention to the losses. A fundamental principle behind the corporate tax regime is that the corporate tax is meant to be paid on the total profit of a business over its entire life cycle and not just a single financial period. Now, accordingly, and in line with the international best practices, a business will be able to offset a loss incurred in one period against the taxable income of future periods up to maximum of 75% of the taxable income in each of the future periods. However, tax losses can be carried forward indefinitely, provided the same shareholders hold at least 50% of the share capital from the start of the period till the end of the period. Even if there is change in the ownership of more than 50%, losses may still be carried forward, provided the same or the similar business is being carried on by the new owners. Now, this condition of continuity of the business and continuity of shareholding and the business requirements, it will not be applicable to businesses that are listed on the recognized stock exchanges. Now, on the other hand, as they have given losses that can be carried forward, they have also mentioned that no tax loss relief will be available in the following losses. Firstly, it will not be available for the losses which are being incurred before the effective date of corporate taxation. I think this is very logical for them to not allow taxes which are incurred before the effective date of corporate taxation. Apart from that, before becoming a taxpayer for UAE corporate tax purposes, those losses will also be not allowed. Similarly, losses incurred from activities or assets which generate income that is exempt from UAE corporate tax, even those losses will not be allowed. And losses incurred by free zone person that is not attributable to a permanent establishment in the mainland, those losses will also not be allowed. Moving on, now I would like to highlight groups. Now, another important aspect which businesses nowadays have, that is groups. Now, what do you mean by groups? Significantly large businesses conduct their operations through a group of companies. They have one parent company and a number of subsidiaries. Now, operating through a group of companies can increase the overall tax compliance cost, where each entity needs to report their taxable income on a standalone basis, and can result in higher effective tax rate for the group, wherein such companies are profit-making companies and other may be making the losses. Now, in order to mitigate this complete burden on the businesses, the UAE corporate tax regime will allow consolidation for tax purposes, which is known as tax grouping, for essentially wholly owned group of companies, and transfer losses between the group companies that are 75% or more commonly owned. Hence, the group of companies can transfer losses and form a tax group, become a single taxable person, provided the parent company hold at least 95% of the shareholding. Now, a subsidiary can also be a part of this tax group if it is indirectly owned by a parent company. Hence, the group of company which meet the above condition, that is, they can elect a tax group, be treated as a single taxable person, and along with that, the parent holds 95% of the shareholding. They enjoy the benefits of intra-group tax losses. But however, if anyhow they could not form a tax group, or the parent does not hold 95% shareholding, losses can still be carried forward, and losses can still be set off between the company, provided there is 75% or more of common ownership between the tax groups. So that way they can also be benefited from this tax losses set off. Now, along with that, a notice is also to be given to the FTA before forming a tax group. If the group wants to elect a tax group, they have to notify to the FTA. The more detailed discussion on the group of companies and tax group and this relief will be done by us in upcoming days. Now, it has been seen in many countries that they have a complicated tax paying system, and on top of that, they have complicated calculation as well. Almost everyone has this question in mind, that on what amount they have to pay tax, how will they pay tax, how it will be calculated, what are the steps to calculate. Well, I think MOF has kept a very simple calculation for corporate tax without any confusion and drama. It simply says that corporate tax will be payable on annual tax income which is exceeding 375,000. Below that, they won't be taxable. So if I have to explain in a very simple language, if I say that your business income is 5 lakh AED, then you have to pay tax only on the differential amount, that is 5 lakh minus 375,000 AED, and 1 lakh 25,000 AED will be considered as your taxable income, and you have to pay corporate tax on that differential amount of 1 lakh 25,000 AED at the rate of 9%. Now, to avoid a double taxation, the UAE tax regime will allow the credit for the tax paid in the foreign jurisdiction against the UAE corporate tax liability on the foreign sourced income that has not been otherwise exempted. This is known as foreign tax credit. So the maximum foreign tax credit that will be allowed will be lower of the amount of tax paid in the foreign jurisdiction or the UAE corporate tax payable on the foreign sourced income in UAE. The notable point in foreign tax credit is that any unutilized foreign tax credit will not be allowed to be carried forward to other periods, nor will FTA refund any unutilized foreign tax credit if any of it is lost, it's lapsed, then you cannot carry it forward, neither you will be able to claim the refund of same. Moving on to the withholding tax. Now, what is withholding tax? Withholding tax is a kind of tax deducted at source which is levied in one country and paid to a person resident outside that country. For example, royalties, interest, dividend, etc. These are subject to withholding tax. Now, given the position of the UAE as a global financial center and an international business hub, 0% withholding tax will apply on domestic and cross-border payments made by the UAE business. This is one of the very important aspects which has been given in this UAE proposed law. Now, as the following income will be subject to 0% withholding tax. First and foremost, income earned by foreign companies in UAE that is attributable to a permanent establishment in UAE of that foreign company. Mainland UAE sourced income earned by a free zone person as they benefit from 0% corporate tax regime, and dividends and other profit distributions made by free zone person to a mainland UAE shareholder. Last but not the least, now I would like to bring your attention to the filing due dates, which may seem a little confusing, but let's simplify it. So if your financial year ends on 30th June, your first tax period will be from 1st July 2023 to 30th June 2024, and your filing and due date payment will be 31st March 25. Accordingly, if your financial year ends on 31st December, your first tax period will start from 1st January and it will end on 31st December 2024. And your filing and due date payment will be 13th September. And lastly, if your financial year ends on 31st March, then your first tax period will start from 1st April 2024 and it will end on 31st March 2025. And your filing and due date payment will be 31st December 2025. The return is to be filed and taxes are to be paid within 9 months from the end of the tax period, irrespective of your tax period. Well, now as the regime is completely new, it's better that we get started and buckle up to start this journey. In my opinion, I would suggest the following steps for you to take in order to be prepared for the corporate tax. First and foremost, get a good understanding of this proposed UAE corporate tax legislation and fully assess the implications, which may require the changes to the legal structure, the business model, the accounting and profit systems, and even your organizational structure, etc., etc. Secondly, alert the tax and finance teams should be ready to start conversations with the different departments and stakeholders within the businesses and anticipated impacts. Now, as soon as the law comes into action, take proper guidance and support from the tax advisors and professionals. And lastly, as now this will be a process of filing tax every year and preparing your return every year. And many questions may arise and changes will be made as and when this law will flourish, more clarity will be gained and we will be able and on that process, you will be requiring a professional legal help on each and every step. Well, this was all from my side. We have tried to capture the key aspects of the same for your better understanding. In upcoming days, I think we will come with more videos and clarifications on the corporate tax regime in the UAE and try our best to provide you with and deliver our best to you. This is the last piece of advice from my side. That is, take my advice, stop thinking of it as your money and just completely leave on us. I will now like to have some question answer session. So would you like to add something?
Yeah, thank you,
Yes,
Karishma. Thanks a lot for your flawless presentation. And particularly the advice on the last slide. Stop thinking this 9% as your money now. Now, I'm sure there are many burning questions in the mind of our audiences. And as we see in the chat box as well, let me also ask you some very important questions,
sure.
which we all time hear from many clients that we see. One of the question which I'm sure will benefit most of the people is, where it is most beneficial to incorporate an entity now in UAE. If it's a mainland or a free zone, where do you think people should go for an entity, particularly from seeing it from corporate tax perspective?
But undoubtedly, it would be free zone entity, whether the entity is engaged in the international business and where income is not derived from the UAE mainland. If a free zone person supplies to a free zone person or even export to foreign countries, then income will not be considered in the corporate tax regime. However, income from mainland, either through branch or unrelated business, will be considered as a taxable income and corporate tax will be liable to be payable on that income. While on the other hand, if you are a mainland business, then your global income will come under the purview of the corporate taxation and you have to pay corporate tax on that entire global income. So thus, considering the above constraints, I think it is very clear or it is very beneficial for the people to, for the free zone persons, and they will be more benefited from this corporate tax regime. Okay,
there is a related question that is asked, from Dr. Kanak Ji Madrecha. He's a well-known professional in UAE, a mentor to me as well. So his question is, if software is imported from principal in Europe, if an entity is importing a software from a principal entity from Europe and through its agent in UAE, the software is being marketed and sold in UAE, how it will be taxed and will it be taxed? I have my views. I'll answer this question. So apparently from the question, it seems that the software, the income is being generated from its business in UAE. So if the software is being sold to a UAE resident person or a mainland entity, the income related to that particular bit will be taxed. However, if it's a free zone entity which selling it to the same free zone or any other free zone, that particular portion of income might not be taxed. So just to answer and to summarize, I mean, anything that will be charged, between the two group companies will be first determined based on arm's length principle, transfer pricing principles, and the sale from UAE entity to other entities in UAE, the free zone entities to other entities in UAE, particularly mainland, will be a taxable income. Sales from free zone to free zone entities will not be taxed. So you will have to maintain the separate P&Ls if you want to claim the tax benefit. Hope that answers, Dr. Kanak. So moving on to the next burning question, Karishma,
Yes.
if UAE is a home to many holding companies, will UAE holding companies be exempt from corporate tax as well?
Well, recognizing the UAE's position as international hub and a leading holding company location, it has been proposed in the law that it will exempt certain forms of income from taxation. The main exemption that the holding companies may get from UAE corporate tax, it relates to income earned by UAE companies from investment in other companies and from operations conducted outside the UAE through foreign subsidiaries or foreign branches. Thus, it can be said that as the main UAE sourced income will be taxed, it will get benefited.
Thank you. Thank you. I see one question in the chat box from Mr. Rakesh Nandi. And I also had this question, what is the audit requirement under corporate tax? And I would rephrase this question as well in different way. Do entities required to get their books audited even when they are subject to 0% corporate tax rate?
Yes, absolutely. It has been specifically given that the UAE corporate tax under this UAE proposed law that it has to maintain audited statements for free zone entities who wish to claim 0% corporate tax rate. So if you want to claim if you want to be under the 0% corporate tax regime, then you have to get your books of accounts audited. So interestingly, I would just like to highlight one point that it only talks about maintaining adequate records for all other entities.
So just to clarify, if you are a free zone entity wanting to claim 0% tax rate, you must get your accounts audited.
Yes.
And if you are a mainland entity or any other entity with a 9% tax rate, then they only talk about maintaining adequate records. They don't talk about auditing the books of accounts.
No, that's actually very interesting thing.
Okay. Thank you, Rakeshji. I hope this answers your point. I'll ask another question, related to free zone entities and all. Will offshore companies, like we see a lot of offshore companies in Rakis, Zabza, will they be subject to corporate taxation?
While the Ministry of Finance, there were certain FAQs which were raised in it, but they do not address whether such offshore companies will be subject to UAE corporate tax. It hasn't yet been clarified upon it. But we would expect them to be treated in line with the general free zone entities, wherein their overseas or international trade income will not be taxed, but their UAE sourced income will be taxed, and that will come under the corporate tax regime.
Thank you. That clarifies. I think a lot of clarifications will come, and we hope that they should clarify offshore companies and distinguish between offshore companies and free zone companies.
Yes.
And one question again regarding audit from Mr. CP Joshi. He's asking if net income is below 375, is it mandatory to audit?
That is for entities.
Yeah, I think the audit is mentioned in the document. It talks about auditing only if you want to claim 0% tax rate uh, being a free zone entity. It doesn't talk about, audit. It only talks about maintaining adequate records, related to your taxation. Even if you're coming into different slabs, and if you are saying that I am subject to 9% corporate tax rate, but anyway, all entities till 375,000 dirhams are in 0% tax rate, it currently does not talk about audited books of accounts. It only talks about maintaining adequate books of
The records.
adequate records. And we will have to see what it means as far as the adequate books of records are concerned. So I'll ask another question to you, Karishma. I mean, which a lot of people do have. Between the various free zones, and I think we covered in our presentation somewhere before. Between the free zones, which one is more beneficial to open an entity from corporate tax perspective?
Well, I would say designated free zones. Like in Abu Dhabi, we have free trade zone of Khalifa Port, Abu Dhabi Airport free zone, or Khalifa Industrial Zone. In Dubai, we have Jebel Ali free zone, Dubai Car and Automotive Zone, Dubai Textile City, and so on. And even in Sharjah, Ajman, Ras Al Khaimah, and Fujairah. So I would say that these designated free zones who supply goods to UAE entities, they will continue to benefit from the UAE corporate tax regime. While such benefit is not extended to the entities which are in non-designated zones.
Thank you for clarifying this. Another question. I mean, we have some questions in the chat box as well, but I want to ask some very basic questions as well for the clarity of our audience. What about a free zone entity which is mainly engaged in international trade and does not do any business in UAE, and it is subject to 0% tax rate? Do they still need to register with FTA and file the tax return?
Yes, absolutely. They are subject to 0% corporate tax regime, but they are part and the ambit of the UAE corporate tax regime. So they will be required to file their annual return at 0% corporate rate tax, and thus they will be required to register and file their tax return.
So as long as you are under the preview of CT regime, corporate tax regime, even if it's a 0%, I think it's most likely that they will be required to file the returns.
Yes.
And register also.
Right.
Okay. And we talked about deductible expenses vis-a-vis non-deductible expenses and all that. Can you also shed some light for our audience on remunerations that are paid to related or connected persons, such as expense? Can such expense be deductible from taxable income? And if yes, to what extent, to what amount?
Well, absolutely. This remuneration paid to related parties and connected persons, they will be allowed as deduction. Though this proposed corporate tax legislation does not prescribe any such amount or limits up to which they would be allowed, but however, they are usually deductible on a reasonability principle of arm's length basis. So one cannot claim the exorbitant amounts in order to reduce the tax liability. So it's better to always go as per the international standards, and it clearly specifies that the remuneration and other such expenses to related persons and connected persons should be deducted at arm's length price.
Okay. Thank you. So also one more question, many of our clients would have that, and many groups in UAE would have that challenge of having group and multiple companies within the group. So some companies might be in free zone subject to 0% tax rate, while some companies might be in mainland subject to 9% tax rate. Do they require to make a single tax group if they are part of the same group for such entities? Or not?
If you're asking me they are required, then I would specifically say that that is not about the requirements. That in short, it's not allowed only in the proposed law, because it has been very specifically cleared that a tax group cannot be formed between entities with 0% tax rate and 9% tax rate.
Thank you for this clarification. If you are a part of the same group, and if you want to claim 0% tax benefit for one of your entity, then that particular entity cannot be part of the same group in terms of grouping of the grouping provisions of this provision of this tax. Okay, one question that is related to carrying forward of losses. How about, for example, a startup that is incorporated in 2021? We have seen the euphoria of startups recently. And as usually startups, which this particular startups is currently incurring losses in this financial year, maybe next financial year as well, and expect to turn profitable in 2024, which is its first assessment period. Can it claim benefit of historic losses to be carried forward, once it hits profitability?
No. It's very clearly being specified that if you're not being, if you are the losses, the tax losses that can be carried forward, it will only be available or only be eligible after the effective date of the corporate tax regime, that is after 1st June 2023. So before that, how come, or as many losses you may have, you have to leave it there. You cannot carry forward it against your future taxable profits.
Got it. So it only allows to carry forward of losses post implementation of this CT.
Yes.
And is there a time limit of carry forward of losses in the proposed consultation document?
No time limit as such. Whenever you're filing your first income tax return, whenever you're filing your first return, in that you can. However, no such time limit has yet been specified. As soon as it comes, we may get more clarified about it.
Yeah, I think Karishma, it clearly said it can carry forward losses indefinitely. Right. So that's the important point in the consultation.
Subject to certain conditions have also been given in them. Yeah.
Correct. So okay, one question, I'm sure a lot of people might have that as well. Will this new corporate tax regime, what do you think one should keep in mind while maintaining their books of accounts? I'm sure there would be many, but can you please specify certain very basics in that?
Yes. Actually, there are n number of things that they should keep in mind while maintaining the books of accounts, but I would like to highlight few of them. Very first and foremost thing would be maintaining a separate ledgers for deductible and non-deductible expenses, as it has not yet been clarified that what is being included. But as soon as we go, we'll have idea. One of the non-deductible expenses which have been specifically specified in the law, that is entertainment expenses. So it's better you maintain separate ledgers for those expenses. Now, if you are a free zone entity, particularly a non-designated free zone, then doing business in mainland, you need to maintain separate P&L related to mainland business, and your accounting system needs to be designed accordingly. Thirdly, if you are a free zone or an offshore entity, you must get accounts audited if you wish to claim 0% tax benefit. Now, again, it has just been specified that if you are a free zone or offshore entity, only then you need to get your accounts audited. Along with that, as interest capping rules have been given only up to 30% of the EBITDA, it's better that you maintain separate records for interest expense as well. Lastly, if you are dealing with one of your group entity, which is in a free zone, and the other entity claims, and that entity claims 0% tax benefit, then any expense amount to your group entity, it will not be allowed for your corporate tax calculation. So you need to maintain separate records for those records also in your books of account. I think these are the major things which you should keep in mind while maintaining your books of accounts.
Okay, one last question from my side, and then we will take some queries from the chat box as well.
Sure.
How about an entity in Cayman or Seychelles, which still offers 0% tax rate, but managed by UAE resident person? Will such entity be subject to UAE corporate tax regime?
Yes, absolutely. Actually, I would say that for the application of UAE corporate tax, it is very clearly specified that even if you are a foreign entity, but you are being effectively managed and controlled from UAE, then you will be treated as a UAE incorporated entities, and you will come under the corporate tax regime.
I
I
see.
hope this clarifies.
Yeah, I also see that in such cases, we need to see if such entities will be treated more like a free zone or a mainland entity. We need to see that, because free
Yes.
zone have a little distinctive advantage when it comes to CT. And I think there will be more clarity on this matter from FTA. One interesting question I'll take, I know I'm cautious of time, we'll take another 3 more questions. Let's see, before we wrap it up. There's a question from a gentleman, Vishal. Would it be more advantageous to file the corporate tax as a separate companies instead of a tax group? We would get an exempt of tax on up to 375,000 for each company. So, Vishal, I'd like to take this question. I would wish, that this 375,000 exemption limit we get by company, even if we form the group, because otherwise it would be very disadvantageous from a tax grouping perspective if this limit is not per entity. So although the further clarifications are, will only be able to, answer this particular question, but from a logical, from a point of view, it would become seriously disadvantageous to form a tax group if the limit for the whole group remains only 375,000 dirhams. So I'll take some another question. There is a question from Mr. GK Raviji. Raviji is asking, probably from his interest income, presuming interest income on FDs placed by free zone companies with banks in mainland will be exempt from corporate tax. What's your views, Karishma?
Sorry, sir. I just missed it. I'm so sorry.
So the question from Mr. GK Ravi is, he's probably asking that interest income on FDs placed by free zone companies with banks in mainland will be exempt from corporate taxation perspective. So let me take this if it's okay.
Yes, yes, okay.
I think it has nothing to do with free zone vis-a-vis mainland in this
Correct.
particular thing. I think this particular income, interest income, all passive incomes are in the exempt category. So the corporate tax regime does not intend to charge anything which is passive income. So whether it's a free zone company, mainland company, if the interest income, is not subject to, as long as it's not a main business, the leasing or financing is not the main business, the passive income is not subject to corporate income tax. There's another question from Mr. Jitendra Bora. He's asking, will transfer pricing be applicable to domestic transactions or only international transactions? I think, Jitendra ji, this particular thing, transfer pricing is mainly to do with inter-company or inter-related party transactions, whether domestic or international. So, when even within UAE, for example, an entity which is subject to 0% tax rate vis-a-vis 9% tax rate, both are UAE entity, one mainland, one free zone, but probably it will be, this transfer pricing provisions will apply and the arm's length principles will apply in that case as well. I hope that answers your point. Again, interest also, we have another question from Mr. Nandi. I think that answers that. So, just one second. Let me, before I take any further question, I'm taking the backup of this chat box so that if there is anything remain unanswered, I'll come back to you separately. There are a lot of questions in Q&A as well. Let me take some questions from Q&A box. I think we have answered. Is there any tax audit, any qualifications for the tax auditor? We don't know. This doesn't talk about any tax audit matters at this point of time. So, this particular document does not talk about it. And the qualification also, it doesn't talk about any on that front. So we will wait for further clarifications on this. This is done. Okay, there's another question from Mr. Nitesh. Free zone entity trustability on both the entities. See, Nitesh, if a free zone entity is selling to mainland entity, the tax liability is on the company which is making the profits. So we have discussed about designated vis-a-vis non-designated free zone. If it's a sale from designated free zone to a mainland entity, then it will not be taxed in the hands of the selling party. If it's a sale from a non-designated free zone entity to a mainland entity, then it will be termed as UAE derived income, and it will be taxed. Hope that clarifies. We'll take two more questions in the interest of time, and then we will try to answer individually as well. Mansoori ji is asking, is there also a timeline to file the tax return? Karishma, you want to take this?
Yes, sir. There is no as such timeline which has been specified as of now.
9 months.
No, that's only for filing the tax return. Yeah. And within 9 months from the end of whatever is your tax period, irrespective of tax period, if it's ending on 30 June, 31st December, 31st March.
Can you pull that slide for the benefit of Mr. Mansoori?
Yeah, sure.
Yeah, so that.
Yeah, so the corporate returns, it must be filed within 9 months from the end of the tax period. So whatsoever is your tax period, within 9 months from the end of that, you have to file the return. That's the only timeline as of now which has been clarified.
Perfect. So if your first tax period for entities who are following calendar year will be the September 2025, because 9 months after completion of first year, which is from 1st January 24 to 31st December 24.
Right.
Hope Mansoor ji clarifies your point. Again, another question. Does the new regulation require all corporates to have audited balance sheet and file its tax authorities regardless of its taxable income? I think we already answered this.
Yes.
That it talks about auditing only if you want to claim 0% tax rate. I'm reading some of the questions, please, if you allow me. So there is one question from Prangya. And the question is, if a free zone company getting some of its income from a mainland company in UAE, i.e. 10% of its total income, then whether total income of free zone company is taxable or only the income derived from mainland company is taxable?
Well, can I answer this question, sir?
Yeah, please.
Yes, it's only the mainland income that will be taxable. So if your 90% of the income is exempt, that will come under the 0% tax regime, and 10% of income which is from mainland, it will be chargeable to 9% corporate tax.
So you need to maintain two P&Ls, in fact.
Yes, yeah. Specifically, as I told, in the maintenance of account, one of the question that you asked, I specifically told that if you are having free zone as well as mainland income, then it's better that you maintain separate P&L for both of it. So even you have the idea about what will be taxable and what won't be taxable.
Okay, there is another interesting question from Nisar Gulati. He's asking, for companies under liquidation, will corporate tax apply? Do you want me to take this?
Yeah, sure, sir.
So companies do need to register with corporate tax authorities, which is with FTA, and companies also need to deregister with FTA. So if you feel that you are getting in liquidation, you will be liquidated in some time, then you need to deregister with FTA. FTA will verify the records apparently from the document that is published, and then they will deregister. Then you need not file the corporate tax return. But till then, CT will remain applicable on you if you are already registered. If you are not even registering, FTA can register you as well if they feel that you are subject to corporate tax. I hope this clarifies, Nisar. So answer live done. Okay, there's one question from Amjad. This will be our last question, and then probably we'll try to come back one-to-one with unanswered queries. Please repeat and confirm if unrealized income will be part of income while calculating the taxable income.
Can I go to that slide?
Yeah, please go ahead.
It will be easier for them also to understand.
Yeah, please.
Yes. So, answering your question, I would like to say that only the capital items, unrealized gains or losses on capital items, it will not form part of your taxable income. But unrealized gain or losses on your revenue items, it will form part of your taxable income. So you can consider that while calculating your taxable income for corporate taxation.
Yeah, thanks for clarifying, Karishma. But here I would like to add one point. That if you are following IFRS principles or any other globally accepted accounting principles, correct? All the the calculations will be based on that.
Right.
So unrealized, like for example, inventory needs to be valued at cost or net realizable value perspective. To that extent, your unrealized income related to your inventory will not be taxed because you are following the IFRS principles. Correct? But any other revenue item which is mark to market, for example, you are in a equity trading business and it needs to be mark to marketed, then it probably would require even unrealized income to be part of the taxable income. So I hope that clarifies. Anyway, I think we have many queries here. In fact, I wish to answer all of them, but I hope that we have been able to do justice with this. Let me take a backup again, because I'm sorry, I'm not able to read all the queries that are coming here. Okay. So we'll conclude this. I think as as I said, as time is of constraint and all the queries and doubts to answer, we request you to please feel free to share your contact number and email ID in the chat box. And we will certainly come back to you along with your queries. Please share that. I hope you got some insights today about the proposed corporate taxation through this webinar. And also some of your doubts have been resolved. To conclude, I would just say that this is just the beginning of a new era in UAE. And as the world changes, we change. As change is the only constant in the world, we at MI Gabriel Services will be happy to serve you in this changing environment and support you with all the required assistance during this journey. Thank you again for your precious time and the overwhelming response to this webinar. And I still see a lot of participants active. And we promise to connect with you all again on this topic. Thank you again and have a wonderful evening. Thanks a lot.